Auckland's secondary office buildings are sitting with a 22% vacancy rate right now. 1 in 5 office floors empty. And here's what makes this number genuinely alarming. That's higher than what Auckland saw during the global financial crisis. If you own commercial property in the CBD, or you're thinking about investing in office space, this is the single most important market shift you need to understand heading into 2026. Because whilst the headlines keep talking about residential property corrections, there's a completely different story playing out in Auckland's commercial sector, and the gap between winners and losers has never been wider. So what's actually happening here? Auckland's commercial office market has split into two completely separate worlds. At the top end, prime-grade buildings, your newer developments, green-rated premises, the trophy assets in places like the Wynyard Quarter. They're holding up remarkably well. Prime vacancy sits at around 11%, which is elevated but manageable. Some of these buildings are actually seeing rents edge upwards. But secondary stock? That's where the pain is concentrated. We're talking older buildings, the ones without modern fit-outs, the ones that haven't kept up with environmental standards. Those buildings are hemorrhaging tenants at a rate we haven't seen in over a decade. Secondary vacancy has climbed from around 18% to 22% in just the past year alone. Here's why this is happening. COVID changed how businesses think about office space permanently. It's not just about working from home a couple of days a week anymore. Companies realize they don't need as much square meterage as they thought. A business that used to house 100 people in an older building can now fit comfortably in a smaller, more efficient prime space with 70 desks and hot desking for the rest. They're shrinking their footprint while simultaneously upgrading quality. And when you look at the numbers, this flight to quality makes complete sense. Tenants are moving into buildings like 30 Daldy Street in the Wynyard Quarter, Beaka House, the refurbished 2 Wakefield Street behind Eodia Square. These aren't just prettier buildings. They've got better air quality, natural light, collaboration spaces, end-of-trip facilities. The kind of stuff that actually gets workers to show up instead of staying home. Meanwhile, landlords with 1980s office towers are sitting there watching their occupancy numbers collapse. And here's the brutal reality. They can't compete on amenity, so they're trying to compete on price. But even aggressive rent reductions aren't filling the space fast enough because tenants would rather pay a bit more for a building that doesn't feel like a relic. Let's talk about who's actually affected by this. First up, landlords with secondary stock. If you own one of these older buildings, you're facing a perfect storm. Vacancy is climbing, which means rental income is dropping. At the same time, operating costs haven't gone anywhere. Rates bills keep rising. Insurance premiums are up. Maintenance hasn't got cheaper. Your net operating income is getting squeezed from both ends. And it gets worse when you talk to the bank. Commercial property valuations are tied to income. And if your building is half empty, the valuation drops. That puts pressure on loan covenants. Some owners are being forced into capital calls or refinancing at higher rates just to meet their banking arrangements. We're not seeing widespread mortgagee sales in the commercial sector yet. Not like what's happening in residential South Auckland, but the stress is absolutely there. Owners who bought these buildings in 2019 or 2020, when yields were tight and prices were high, are now sitting on assets worth significantly less than they paid. Then there's the flip side. If you're a tenant in Auckland right now, you've got more negotiating power than you've had in over a decade. Landlords are offering incentives that would have been unthinkable 3 years ago. We're talking rent-free periods of 6 months, full fit-out contributions, flexible lease terms. In some secondary buildings, landlords are essentially paying tenants to move in just to get bodies through the door and avoid the building looking abandoned. For businesses, this is a genuine opportunity to upgrade. You might be paying $300 per square meter in an older building. For an extra $100 to $150 per square meter, you can move into a prime asset with double the amenity and half the hassles. When you factor in the incentives, the effective cost difference narrows even further. But here's where it gets interesting for investors. Prime-grade buildings are still trading. There's still buyer interest for well-located assets with strong tenant covenants and long leases. The Finance Center sold for $104 million last year. That's a building with quality tenants in a strong location. Investors are willing to pay for certainty. Secondary stock? That market has basically frozen. Nobody's buying unless they've got a very specific repositioning strategy, or they're getting an absolute steal. And even then, you're taking on significant risk because you don't know how deep this correction will go or how long it'll last. Now let's zoom out and look at what's driving all of this beyond just COVID. Auckland's economy has been sluggish. We saw GDP growth stall out through 2024 and early 2025. Unemployment ticked up, not dramatically, but enough that businesses got cautious. Public sector job cuts didn't help, particularly in Wellington, but Auckland felt it too. When businesses aren't growing, they're not taking on more space. In fact, they're looking at their current lease and asking whether they really need all of it. We've seen companies downsize from 2 floors to 1. We've seen firms that used to have individual offices move to open plan to reduce their footprint. At the same time, Auckland CBD has been adding new supply. Several major developments completed in 2024 and early 2025. We're talking nearly 30,000 square meters of new prime space. Now, most of that was pre-leased, but every tenant that moved into a new building left space behind somewhere else. That backfill space adds to the vacancy numbers, and in a soft market, it's hard to find replacement tenants quickly. So you've got reduced demand, increased supply, and a structural shift in how much space businesses actually need. That's why this isn't a short-term blip. This is a market finding a new equilibrium. This is not financial advice. Always consult a qualified professional before making any property or investment decisions. Right? So what are informed investors and landlords actually doing in this environment? Let's walk through a few scenarios people are exploring. Option 1. Landlords doubling down on repositioning. If you own a secondary building and you've got the capital, some landlords are biting the bullet and investing heavily in refurbishment. We're not talking about a fresh coat of paint. We're talking about gutting the interior, upgrading mechanical systems, getting a green rating, modernizing end-of-trip facilities. The idea is to compete with prime stock rather than try and undercut on price. It's expensive up front, but if you can shift your building from secondary to prime, you're playing in a completely different market with much better long-term prospects. The risk? You're spending millions on a gamble that demand will return for that specific location. If you're in a marginal precinct, no amount of refurbishment might bring tenants back. Option 2. Investors targeting prime assets for long-term hold. There's a group of investors who are looking at this market and seeing opportunity, but only in prime stock. They're not touching secondary buildings at all. The thinking here is straightforward. Prime buildings with strong tenants and long leases are de-risked. Yields have widened out a bit, which means you're getting better income returns than you were 2 years ago. And with interest rates coming down from their peak, the cost of debt is improving. These investors are willing to accept modest capital growth, or even flat capital values, as long as the income stacks up. They're looking at a building in the Wynyard Quarter with a 10-year lease to a blue-chip tenant and thinking, that stable income in an uncertain world. The downside? You're paying premium prices for premium assets, and if the economy softens further, even prime buildings could see vacancy tick up. Option 3. Opportunistic buyers eyeing distressed secondary stock. Then there's the contrarian play. Some investors are circling secondary buildings that are genuinely distressed. Landlords who need to sell because they can't meet bank covenants, or they've run out of cash to cover shortfalls. The pitch here is simple. Buy at a massive discount, hold through the tough period, and wait for the market to recover. This only works if you've got deep pockets and a strong stomach. You might be buying a building that's 40% vacant with no immediate prospects of filling it. You'll be bleeding cash for years. But if you can hold on long enough for the cycle to turn, and if your location is fundamentally sound, you could end up with a decent return. The risk? The market might not recover the way you're hoping. If structural changes mean Auckland simply doesn't need this much secondary office space anymore, you could be holding a stranded asset. So where does this go from here? The Reserve Banks brought the official cash rate down to 2.25% as of late 2025, and there's talk of further easing into 2026. Lower interest rates should help. They make borrowing cheaper for businesses, which could spur some expansion. And if GDP growth picks up the way forecasters are suggesting, we might see employment stabilize and businesses start thinking about growth again. But let's be realistic. Even in a recovery scenario, Auckland's office market isn't going back to 2019. The structural changes are here to stay. Businesses have figured out how to operate with less space, and they're not going to unlearn that just because the economy improves. What we're more likely to see is continued divergence. Prime buildings will tighten up, vacancy rates will come down, rents will firm, and investors will start feeling more confident. Secondary buildings? Some will reposition successfully. Others will convert to residential or mixed use if the economics work. And some will just sit there, half empty, waiting for a buyer with a plan or a landlord willing to write down the loss. The commercial property analysts at CBRE are forecasting total returns to hit double digits by 2026, driven by yield compression and modest rent growth. That sounds optimistic, and it probably is for prime stock. For secondary, I'd be more cautious. The path to recovery there is longer and steeper. Here's what you need to take away from this. Auckland's commercial office market is not crashing uniformly. It's splitting into winners and losers. Prime buildings are holding their ground and will likely strengthen from here. Secondary stock is under severe pressure, and some landlords are facing genuine financial stress. If you're a tenant, this is your market. Use it. Negotiate hard, get incentives, upgrade your space. If you're an investor, know what game you're playing. Prime for stability, secondary only if you've got a clear repositioning strategy and capital to burn. And if you're just watching from the sidelines, trying to understand what's happening in New Zealand's property markets, subscribe to the channel. Drop a comment below. Are you seeing these dynamics play out in your business or your building? And if you found this useful, hit the like button. It helps us keep making content like this. The commercial property market is always a leading indicator for where the broader economy is heading. Right now, it's telling us we're in a period of adjustment, not collapse, but recalibration. And the investors who read that signal correctly are the ones who'll come out ahead.